Hi everyone, my name's Tim Fairweather and welcome back to another simple daily practice drill that you can use to become a better trader. And this one is called the High One Fade. In this video, I'm going to talk about a variety of ways you can explore it: consecutive entries, counter trend, stop location. We're going to look at possible targets and how they work in a trading range. If you've seen my earlier videos on spikes, spike indicators, stop entries, and spike high ones, basically a lot of videos about spikes, you realize most of my trading has to do with breakouts, either breakout pullback for a second leg or just trading the breakout for a second leg. What I'll do is I'll quickly cover how to trade the spike high one on this chart, and then I'll get to talking about how to fade the low one. Here is a spike. You're waiting for a pullback and then a buy signal. That's a buy signal. You buy on a stop one tick above that buy signal. You have a protective stop at the low of the spike, and that's your trade. If you didn't take that trade, here's another spike. That bar's the pullback. You buy on a stop one tick above that bar, and you have a stop down here. This is a counter trend spike, typically best to ignore and wait for a second leg sideways to down. There's your second leg sideways to down. It's hard to see, but there's a third consecutive bar there, 3 consecutive bars here. You wait for a pullback. If you don't want to buy above that bar, buying above one of those bars were all good entries. There's also another way to trade this, and that's called, because we're going up, it's called a spike low one fade. We've just created a new spike. We've got a new high of the day, and now this bar has gone below the low of that bar. So there's a couple of possibilities. Some traders might buy on a stop one tick below there. Other traders might wait for the pullback bar and buy on a stop one tick below there, betting that will at least go up and test the high. Same again, market's going up. Now you've got a bear bar. The market goes one tick below that bear bar. Some traders might buy there, or because it's closing on its low, they wait. Now you've got a weak looking bear bar here. Some traders bought one tick below that bar, at a minimum, looking to test the old high. One of the principles we've been using in market behavior is that of moves really being two moves. The market has a breakout and then has a second leg. The market tests the high of yesterday, but then it tests again. Most of the price action has this concept of two tests or two attempts. And this is super valuable as a trader. If I'm long and the market is going up, the first time I see a bear bar is the first attempt. Can that immediately fail and reverse? Of course. What does it usually do? It usually takes 2 attempts to reverse. And that's why we call it a second entry short or a second entry long. If you've watched my earlier video on high twos, that's where we've got a breakout to a new high and the pullback has pullback high one, pullback high two. It's the second attempt to continue the trend. It's also the second attempt to reverse that pullback. This style of trading is called weak reversal. It's based off a second attempt principle. The market often does everything with 2 attempts. We go up, we have 1 attempt to reverse. Okay, didn't do too much. The market then attempts to reverse a second time. This time it works. We drift back to the moving average. On the way down to the moving average, we then have 1 buy signal here. We go above the high of a bar once. We continue down. Then we have a second reversal signal here. Now we've gone above the high of that bar. So in this example, we've had 2 reversals down, 2 reversals up. So you can take this principle and say, well, I expect the market to have 2 attempts to do everything. Therefore, the first time it reverses, I'm going to be a buyer here. And the second time it reverses, I'm going to exit. And then on the way down, market's going down. The first time it goes above the high of a prior bar, I'm going to be a seller, and the second time I'm going to exit. This is how scalpers trade. So that's principle 1. Because the market has 2 attempts, the first time it does anything is no reason to panic. Take this chart here. If you buy that bar with a stop down there, you've got a bull entry bar. Now you've got a good follow through bar, and now you've got a bear bar. This principle means even if the market goes below the low of that bar, there's probably going to be more buyers below that bar. And in fact, no one wanted to sell below that bar, so this is going to allow you to stay in a position longer. Now the market has gone below the low of a prior bar, and you might decide to move your entry to exit just below that bar, and you get taken out. So the first exercise in this video is to look at this concept of 2 attempts. So 2 attempts to reverse, 2 attempts to continue, 2 tests of yesterday's high or low, So stop the video now and spend 5 to 10 minutes looking for second attempts. This is probably one of the most valuable exercises I think traders should do. Now we're going to look at consecutive signals. In the same way that a spike triggers stop entries and we have a few legs in a particular direction, or we're in a trading range and we have a few failed breakouts before we come out of that range, we also need to look at consecutive entries. I had a trader ask me a question this morning about taking a particular low one or high one fade. And when he sent me the chart, the first entry he suggested was good. The last one, I said, well, there's already been 3 of those entries. And I thought, that's a really interesting point for traders. By the time it's obvious and clear, it's often the 3rd or 4th entry. So even though it's okay to take, you've got to also expect that everyone who took all the earlier entries when the probability was lower is now sitting on a lot of profits. You can also call this entry a microchannel fade. This is a bear microchannel going down. A trader sells 1 tick above the high of that prior bar. You just keep moving your order down until you get filled. Market's going down, and if you're not short, traders put an order above one of these bars and they get filled. At a minimum, they're looking to test the prior low. This is a bad high one. The market's got a lot of stop entry bears selling below the low of prior bars. The first time you get an opportunity to buy above a bar is probably a trap. You'll also notice 1 signal, 2 signal, 3 signal, the 4th signal you got stuck. This was also the same on the way up. And that's because each time we go above the high of a prior bar in a bear leg, that's the end of a leg. 1, 2, 3 legs down, probably breakout mode. Then going on the way up, the first time we go below the low of a prior bar is there. Traders get in. Some traders might see this is a weak bar, so they'll put it below the last strong bar. You get filled there. Now we've got a new high waiting for a high one. If a low one sets up, that's a bad short. That's a buy. New high, go below that low, another buy into breakout mode. So in this next drill, what I want you to practice is look for microchannels. If you haven't downloaded my free spike indicator for TradingView, go to Zen Trading Tech and download it there. Then you'll be able to find way more examples in a much faster time to help you learn this concept. Go and find 20 or 30 of these examples. First, look for the ones with the trend. You can also look at the countertrend examples to see how they fail. So stop the tape and I'll see you back here shortly. Okay, on to drill number 3. So now we're going to look at those signals. You've had a bit of experience trying to find them. And so now we're going to look at how many of them appear consecutively. And I want you to count them and see how often you have more than 3 in a row. Usually by the time the 3rd or the 4th one sets up, that 4th one has a really high probability of failing. You can see on the chart that I put before, the 4th one failed on the way down and then the 4th one failed on the way up. Not a strong buy to buy above, but traders were happy to buy below that bar. Now you've got 3 more bull bars on the way up. Traders buying below the lows of those bars. So it's a low one fade. You're fading the low one entry. Now at some point, this is going to fail. All the way up here, you enter, but in 4 bars, you're still not above your entry price. The moment you see this bar, you've got to get out. Traders then can look to do the exact opposite, looking for a strong bear bar to sell above, to go down. In this section, I want to talk about stop location. So the stop location for a spike trade is usually at the low of the spike or the high of the spike. But there's a couple of other possibilities. If you're using limit order trades to fade, you have a few other options. One is to use a multiple of the signal bar. So if I'm in a bull spike going up and I'm buying below a bar, I might give the trade some room, maybe 1 or 2 times that signal bar. So I have 1 entry there and then I have a second entry lower, or I just have a wide stop. The other possibility is to use the range that you're betting, and so then you have a stop location based on a measured move of that range. Let's talk about stop location. If a trader is going to sell there, the stop has to be above the high of the last sell climax or a breakout bar. You can put it at the high of the day, but you're looking for 1-to-1, and that's where the move ended. When we're talking about stop locations for this trade, well, if you're buying here, you've got a couple of choices for a stop. One is 1 tick below the low of the day. If you're buying below a bull bar and you get a new low, you're probably not in a bull trend anymore. The other options are using 1 or 2 times the signal bar. Whatever you're fading, you're giving it room to get a measured move against you. If you're a buyer here, your stop's here, you're okay. If you decided to sell here, you can't use a stop above that bar, 1 or 2 times the signal bar up there. and you were actually okay. We actually came all the way back to your entry. And that's because this was a wedge and traders expected it to go down. So using that wide stop was actually a good idea. Okay, welcome back. In this section, we're going to talk about counter trend trades. So if you've been working on your context, your leg counting, looking at price moves, and been practicing some of the other drills, you'll start to realize the moment you remove context from anything in price action, it doesn't make sense. We start making stupid mistakes again. And on this first chart, you're going to see how with a gap up and a few legs pulling back to the moving average, selling above that bear bar, which looks good in a bear spike, might actually be the wrong thing to do. Here's a second entry short. You probably don't want to buy below that bar. Here's a second entry long, so you don't want to sell above this bar. This is 3 legs down. You probably don't want to sell above that last leg. That could be the end of the move. And then it went back to new breakout, fade a low one, fade a low one, fade a low one. Now it's on to drill number 4, which is called counter trend. I want you to stop the tape and go and find 20 to 50 examples of counter trend trades, looking at what would happen if you took that trade. Can you get out? Do you get trapped? How would you scale in? It's now showing you that that high probability with trend trade also becomes a very low probability trade. If you're very quick to read the price action, you usually have a way to get out break even, at least one chance. And then if you don't, if it breaks right out against you, then usually you can reverse to try and get that loss back. So stop the tape and I'll see you back here shortly. The next principle is, are all low one fades or high one fades equal? No, I think the best ones have the correct bar in place. What's the correct bar? This is a strong bull spike. If you did fade this low one or this low one, then you need to get out. Now the market's got a new low of the day. Placing an order one tick above a bear bar is a great idea. Placing an order above a bull bar, you had to sit through more of a pullback. So if you are going to fade a low one, it's a better sell above a bear bar. It's also on the correct side of the moving average here. Here, it's a better buy below the bull bar. If you got stuck here, you got out break even. Okay, now let's look at trading ranges. So trading ranges are full of these entries. If you imagine that a breakout, pullback, and then a high one entry is what you see in a bull trend, then that breakout, pullback, high one, when that fails and everyone sells there, we collapse back into a trading range. What typically happens at the bottom is the bear breakout, pullback, low one sell becomes a low one buy. And now you have your top and bottom of the trading range. If you look at a trading range day, high one sells and low one buys that work. So what's the problem? Well, they can be difficult to take. We're constantly trying to trade breakouts, and now you've got your breakout entry. It can be quite difficult to take that entry. In trading ranges, these are very aggressive. Breakout, pause, here's a high one buy signal, but more traders actually sold it. The market should go up here, but if it doesn't, and that sell works, then you know the next time to apply that will be a low one fade. This was a high one fade. Now we're going down, second leg. Instead of selling below that bar, traders bought. Spike, high one. Instead of buying above that, they sold. Instead of selling below here, they bought. Can you see how the trading range is full of these kind of entries? Where you would usually place a buy order, it's a sell order. Where you usually place a sell order, it's a buy order. And that's because traders believe in fading breakouts. Okay, well now we're on to drill number 5, trading ranges. So now what I want you to go and do is find trading range days and try and mark up the high ones that fail and the low ones that fail. And they will be the edges of your trading range. Don't worry so much about how to predict when these are going to happen. And I'll see you back here shortly. In this part, I want to talk about actual risk. I think one way traders use this fading technique is they see how far the trade went against them and then use that as a measurement for where they should exit, instead of just simply fading the reversal and then exiting at a new low or a new high. And I've got an example here of how you can look at that. What about for targets? If you're fading in a bear microchannel like here, at the minimum, you're looking for a new low. Your stop is wide. Your stop's probably at the high of or 2 times the signal bar. You're betting that this leg is strong enough to get a second leg sideways to down. What I measured here is this was your actual risk from your entry. That's the actual risk you incurred. So you don't want to get out before you've received that back. On the way down, say you sold somewhere in here, and now you've got to pull back. Stronger traders were selling above the high of that strong bear bar. They had a wider stop. You could use actual risk or a new low. It's another way to participate in a breakout rather than selling below the bear spike or buying above the bull spike. And the final area for this video, thanks if you hung in there, is called using this as a moving average fade. I said earlier in the video that the best entries match the moving average. That is, we're going up and we're pulling back towards the moving average, we're above it, so you're looking for a buy there. Or we're below the moving average, we're pulling back towards it, and you're looking to sell there. You're basically just fading across of the moving average. Also notice that all the good entries were on the side of the moving average. This moving average is going up, you're fading entries on the correct side of the moving average. You're fading entries on the correct side of the moving average. You're fading entries on the correct side of the moving average. Hey, well, thanks very much for watching. I hope you found that valuable. So there were quite a few drills in there related to this concept. It's one I really love. It's part of my trading technique, my toolkit. It's a breakout pullback trade, and it's one of the entry techniques I use all the time. It has a lot of details around it. It needs a lot of practice like everything, but I think there'll be enough in this video for you to be able to practice and add it to your trading technique. Well, thanks very much for watching. My name's Tim Fairweather from Zen Trading Tech, and I'll see you in the next video.